Alright, welcome. In this video we are going to cover option pricing as it relates to life insurance. We've done a lot of videos on option pricing in annuities, and we've done some videos on just writing options on individual stocks. So if you need a primer on option pricing, there's a video you can go look at called option pricing for insurance carriers. So if you want to watch that video first and really understand how option pricing works overall and then jump back to this one, you can do that. So in this video we're going to cover an actual illustration in life insurance as context to draw out how the option pricing works in life insurance and the differences between life insurance and annuities. So here's an actual illustration: index universal life, male age 45, non-tobacco. Why this age? Well, we know that the younger you are, the less expensive the cost of insurance is, but this is the sweet spot for a person beginning their prime earning years and really be able to sock away money for retirement. So $24,000 a year, that's $2,000 a month. Age 45, we did it for 10 years in a row. So that $24,000, that very first premium check, the $2,000 that we put down, if a week and a half later we're crossing the street, don't look, and a UPS truck comes and kills us, our family's going to get $534,000. Now that's going to grow because we're basically plowing these premiums in. As time goes by, and then we're just going to do this for 10 years, as time goes by, that death benefit stays the same, but as you can see, our accumulation value increases. And then let's say we retired at age 65. So at age 65, that next year we can start taking out $59,000 or roughly $5,000 a month of tax-free income. We're doing this through a policy loan. So as you can see here, policy loan with offsetting interest. Don't worry about that. That's internal mechanics. You're getting this money out tax-free. As you can see, the death benefit starts to reduce. Now, question for you. Could we have taken income out prior to age 65? Well, of course we could. We could have taken it out at age 55 if we wanted to. We could have taken it out any time. So why do I point that out? Well, it's because of this age right here, 59, or the 59 and a half barrier that you have to deal with in an IRA or a 401k, any other qualified plan. If you were 55 or 56 years old and you needed $10,000 or $30,000 to take out to pay for college tuition, could you do that? You sure could. You have an accumulated value of $310,000. You could take out $30,000 completely tax-free, pay for that college tuition, and not have to worry about the 10% penalty that would have been imposed on you at age 59 and a half if it was with one of your normal qualified retirement vehicles. Here, 65, taking the money out on a steady basis, and I just ran this out to age 85. Let's say the person passed away at age 85. They've taken all that money out, and that family still has $113,000 left for a death benefit. Okay, so let's jump back and look at how the math of this works. So we have a person that puts $2,000 a month in, and over that time period, we did it for 10 years, they're able to basically take out $5,000 a month tax-free out. Why such a dramatic increase in their account value? Well, to understand this, we need to look at this through the eyes of an actuary. The smart people that run their algorithms at the insurance companies, because insurance companies are incredibly good at managing risk. That's what they are able to do. But what does an actuary know about life insurance behavior versus annuity behavior? Well, from an actuary standpoint, when a person buys an annuity with a lump sum, and that's what most people do, they put in a lump sum of $50,000 or $200,000 or $1 million, whatever it is. That lump sum, does the actuary know how long that money is going to be there? Do they know the time frame? The answer is they really don't know. Now, that annuity may be a 7-year surrender charge, but we don't know what the overall plan is. The actuary can't determine what they're going to be using that money for. Whereas life insurance, it's a flexible premium. And what does the actuary know? Well, the actuary knows, regardless of their age, whether the person was 45 they put it in, or 55 or 65 or 75, the actuary knows how long that life insurance policy is going to be in place. Even looking at the flexible premiums, the premiums going in, because some people put them in for a certain period of time or not. But what's the big indicator? Well, it's the actuarial tables when a person is going to pass away. He knows how long that money is going to be there if they're a 45-year-old versus 75-year-old, because what can they plan for? What's the exit strategy? Well, the exit strategy is a person's death. Whereas on annuity, you don't know what a person is purchasing that annuity for. You don't know if they're socking away for retirement, or they have some other expense, or they're going to leave it to their family. The actuary just simply doesn't know. So how does that question mark about how long the money is going to be there affect the option pricing? Well, it affects it dramatically. In an annuity, an actuary simply does the option pricing. He always looks at it 1 year at a time. 1 year at a time, because they don't know how long that money is going to be there. Whereas on a life insurance, they can really stretch out that option pricing over a longer period of time, because they know they're going to have the money longer. Now, so I'm going to write this word stretch. They can stretch out their option pricing. And so when you look at the bond portfolio, in an annuity, the bond portfolio is basically maturity matching the surrender period. So if it's a 7-year annuity, the life insurance company is going to keep a sliver out of here, and they're going to keep it short term for early withdrawals, surrenders, and so forth. But a bulk of this is all going to be 7-year paper to match that maturity. What about life insurance? Well, life insurance, because you have different people coming in different times, their bond portfolio looks dramatically different. They can have a lot of different durations. They can have short-term durations. They can have, your 1 to 2. They can have some 3 to 5. They can have a bunch of 7 to 10. They can have some 10 plus, and then you can fill this other slot in with even longer term, right? So, as you know, the longer you go out with a bond, the higher the interest rate. So your bond portfolio, the interest rate, the return in a life insurance portfolio is going to be higher. The life insurance return bond value is going to be higher than it is with an annuity. What's the evidence of that? What is the evidence of that? Well, the evidence is what the caps are. And today, let me just give you a date here. So it's August 12th, 2013, and the 10-year Treasury, is trading right at 1.59%. So that gives you a little context. So the caps on life insurance, believe it or not, are 13%, whereas annuity caps for the S&P 500 are 4.5 to 5. Why the difference? Well, it comes right down here to this bond portfolio. We have more interest credit that you're able to use going toward buying that option. Remember, if that doesn't make sense what I just said, you need to go and watch this video, option pricing the insurance carriers, understand how all that works. The value of the 13% cap is really what drives all this accumulated value right here. If you have higher caps, obviously your accumulation value is going to be much, much higher. Okay, so again, it gets back to the bond portfolio. It's a higher return on life insurance versus the annuity, and the time. the life insurance company, this actuary, has more time to manage. They can be more aggressive on their overall option pricing because they know they're going to have the money longer in a life insurance policy versus in an annuity. Now let's look at another difference that you're going to find in life insurance that you're not finding in annuities today. Maybe one day they will, but it's this right here. So I don't want to go into too much detail because there's a lot going on here, but this is the different accounts that you can choose within this particular index universal life. See index account A, this is basically the S&P 500. So there's our cap of 13%. What is this index account B at 8%? Why is that so much lower? Well, this is really something I think is fascinating on option pricing, and I sure hope it works its way over to the annuity side. But what this is saying is, let's say that you are looking at the stock market. Here we are, we've had 2013, we've had 4.5 years of straight going up, and you don't think the S&P is going to perform as well. So that 13% cap on index account A here, the S&P 500, you can see the 13% right here. Now this is really interesting. This is showing actual numbers, 10-year, 15-year, these are actual from these dates. So this is taking in 2008 and a lot of rocky time periods, and look at the average return that you would have received, 8.13, and then in the 7s and back in the 8s, and that's with this 13% cap. So this is actually what you would have received in an account using the S&P 500, meaning there's years that the S&P was up 20%. Would you have gotten 20? No, you would have gotten 13 because of the cap. But if the S&P was up 10, would you have gotten all the 10? Yeah, you would have gotten all the 10. If the S&P was down 22, would you have gone down? No. Remember, it's an option on the S&P 500. You don't go down, you go sideways in that year. So that's the 13% cap straight on the S&P 500. But let's say you didn't think the S&P was going to do very well because of everything going on. That's where you can use this index account B. And look at this. See what this says, 140% participation. Look at the cap. The cap is 8% for a maximum income credit of 11.2. What this is basically saying is that if you don't think the S&P is going to perform that well, you can take a lower percent of 8% cap, but you can get a 1.4 multiplier on that. So if you take 1.4, if you take your calculator, 1.4 times 8, you're going to get an 11.2% total cap. So what that's saying is that even if the S&P doesn't perform very well, because you have the multiplier of 140%, you can actually get a higher overall cap return. That's a very interesting concept that you can get in life insurance, and again, it comes back to the flexibility that the actuary has in a life insurance contract that they have yet to build in with the annuity. And again, we sure hope we can eventually work our way into that type of strategy with the annuity. But being able to get a 13% cap or be able to get an 8% cap with a kicker of that or multiplier of that 140, I think that's very, very cool. So just to drive this home, if you have, let's do a little graph here, get us some space. So you start off, here's the S&P 500, and the S&P goes up, let's say it goes up 8%. All right, so you're going to get your 8% times 140, so that's where you're going to get your 1120. So you're going to get your 1120 there. Okay. The next year the S&P goes down 10. Do you go down? Nope, you go sideways. So whatever your lock-in period, your original premium was locked in there, that's your new high water mark locked in there. And let's say the market the next year goes up 5, right? It goes up 5. Well, what do you get if you have the 1.4 multiplier? You actually get 7. If you take 5 times 1.4, that's 7, so you would go up 7% here. That's your new floor. The S&P goes down 3. Do you go down? Nope, you move sideways, and so forth. So I just wanted to give you a quick illustration in case you did not go and watch this other video. So let's talk quickly about the tax-free component of this. Remember we said that this $5,000 a month is tax-free. Okay, now there's 2 other videos you want to look at to really dives into why we're such a big fan of this, of getting tax-free income. There's a video called Secret to Retirement Planning. And then there's a third video called Private pension mechanics. And the advantage of how to get tax-free income versus using the typical IRA, 401k. Everybody gets enamored with, well, I get a deduction for the IRA, whereas I wouldn't for the premiums going into life insurance. I get a deduction for IRA and 401k. But remember, when you take this money out at retirement, it's all taxable, every bit of it, where this is tax-free. So I introduced the concept in this video, and then we really go through the mechanics of the private pension here on video number 3. So I hope this helps you understand how the option pricing works in a pure life insurance policy versus annuities, and these other videos should really help you further your education on that. Okay, thanks for watching.